Happy Tuesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Today's episode is another big one. It is also the second sponsored feature for the month. Sponsored features are restricted to just a few a month to ensure that the channel is financially sustainable while reducing the disruptions to the viewer experience. If you'd like to know how I work with sponsors, this information is in the description below. Let's jump in. And first up, we begin in Europe. The UK and European Union declared a symbolic reset in relations on Monday, yesterday, as UK Prime Minister Sir Keir Starmer hosted EU leaders at a summit in London. Framed as a new era of cooperation, the event marked the most significant effort yet under the Starmer government to mend the rift left by Brexit. Key outcomes included a UK-EU veterinary agreement to ease agro-food trade, discussions on defence cooperation, and moves to streamline border processes for travellers. But despite the warm rhetoric, many of the summit's announcements remain incomplete, and several contentious issues are far from resolved. At the centre of the deal was a British concession on fishing rights, allowing EU vessels continued access to UK waters for another 12 years. In return, Starmer secured a SPS agreement that will reduce border checks on farm goods, a step the government says could inject £9 billion into the economy by 2040 and lower food prices for consumers. While economists welcomed the move, critics, including fishing groups and Brexit hardliners, accused Starmer of betraying coastal communities. Quote, "This is a common-sense, practical agreement that moves us beyond the stale old Brexit debates," end quote, Starmer said. European Commission President Ursula von der Leyen praised the deal as a, quote, "new chapter," end quote, commending Starmer's, quote, "leadership," end quote, and expressing hope for deeper cooperation in the future. Other provisions included commitments to improve energy trading, explore linkage between UK and EU carbon markets, and negotiate on youth mobility schemes. British travellers may soon be able to use e-gates when entering EU countries, though this remains only a possibility at present. In defence, the UK will begin discussions to access the EU's new €150 billion weapons fund and will participate in, quote, "regular policy dialogues," end quote. But the specifics, including timelines and costs, are yet to be defined. While Downing Street highlighted recent trade announcements with India and the US alongside the EU deal, analysts note that the cumulative economic gains from these agreements are modest. US-based Bloomberg Economics estimates that the UK-India deal would boost GDP by just 0.1%, while the EU Agro-Food Accord might add around 0.2%. Of course, a more comprehensive agreement with the European Union on trade would result in much more significant gains. Notably absent from the reset were major provisions for the UK's dominant services sector or mutual recognition of professional qualifications, issues long sought by British business groups. Meanwhile, Starmer's balancing act on immigration was evident in the cautious language around youth mobility. EU officials had hoped for a more ambitious agreement, but Starmer insisted any visa scheme would be capped and temporary. The reset also laid bare the structural limits of the post-Brexit relationship. The UK continues to reject rejoining the EU single market or customs union, and the EU refuses to offer cherry-picked benefits without full membership obligations. As a result, the gains from this latest agreement, while politically significant, are limited in scope. While Monday's summit showcased improved tone and intent, the path to a truly redefined UK-EU relationship remains long and uncertain. The world has entered a period of uncertainty and rapid change, an environment which always causes investors to move into gold, causing a new bull market for the precious commodity. The bull market in the 1970s saw 200 all-time highs for gold. 2000's bull market saw just over 100 all-time highs. The present bull market has only seen 74 new all-time highs so far. While gold spot prices climb, the same cannot be said about the companies that explore for gold, develop projects and operate mines. The gold mining industry has faced a critical crisis over the past 15 years. From 2010 through 2025, exploration budgets have stagnated or declined, discoveries have plummeted, and global gold production has stagnated, with projections of a 17% supply drop by 2030. Existing mines are depleted faster than resources are replenished. This underinvestment in new deposits is a massive driver for a potential supply crunch. The last major bull market for gold-related companies occurred more than 13 years ago. While gold has appreciated by 75% from 2011, the JDXJ index has depreciated by 63%. This presents huge opportunities for savvy investors looking to take advantage of these historic trends. And today's video sponsor, AXCP Ventures, ticker symbol GARLF, provides such an opportunity. AXCP Ventures is an investment company whose primary objective is to identify promising investments with a focus on acquiring premier gold projects in North America. And this could be the best time to be looking at companies that own large known deposits of gold in prime jurisdictions. This past month, legendary hedge fund manager John Paulson agreed to acquire 50% of the underdeveloped Dolan gold deposit in Alaska for $1 billion. AXCP Ventures was incorporated to make investments to rapidly capitalize on the distressed conditions of the gold industry. AXCP Ventures' flagship Converse project in Nevada's Battle Mountain Trend, a premier gold jurisdiction producing 75% of the US's gold, is a standout. The project's October 2024 mineral resource estimate reports 5.57 million ounces of measured and indicated gold and 0.42 million ounces inferred, with a drill program launched in March 2025. Insider purchases totaling $1.2 million in Q1 of 2025 signal strong management confidence. For example, in the last week of April alone, Mario Vetro, co-founder and director, purchased a total of 240,000 shares at 15 cents Canadian. The team assembled to run AXCP Ventures has been involved in the discovery of over 20 million ounces of gold with previous endeavors. Here's the value proposition. The company is cashed up with $10 million. Pairs trade at $49 an ounce on average, while AXCP Ventures market cap translates to only $5 an ounce. The business model is simple: drill the properties in order to create the conditions for an exit at valuations comparable to recent ones. This is a speculative move. There is risk, but also potential high upside. Do your due diligence on AXCP Ventures. A big thank you to AXCP Ventures for sponsoring this episode of Market Update. We now return to regular coverage. Washington lawmakers are courting economic peril as they press ahead with a sweeping tax and spending package, risking a, quote, fiscal disaster, end quote, if the US enters a recession, warns Guggenheim Securities co-chair Jim Milstein. Speaking to US media yesterday, Milstein warned that the US deficit, currently at 6.4% of GDP, or around $2.4 trillion, could balloon to $4 trillion in a downturn. Quote, the cost estimates of the current package assume consistent economic growth, end quote, he said, adding, quote, in the last 5 or 6 recessions, the budget deficit actually blows out because tax revenues go down and spending increases, end quote. We note that Milstein served in the Treasury under US President Obama. A key House committee approved the tax and spending bill late on Sunday, pushing forward a measure that the Joint Committee on Taxation estimates will cost $3.8 trillion over the next decade. But fiscal hawks, including the Committee for a Responsible Federal Budget, argue the true impact could be even greater. Long-term Treasury yields have spiked in response to rising fiscal anxiety. Yields on 30-year US bonds surpassed 5% on Monday, shortly after Moody's downgraded the nation's last AAA credit rating to AA1. 10-year yields also climbed, a reflection of investor fears over a swelling supply of government debt. Quote, there's going to be a huge supply of treasuries coming to the market, end quote, said Milstein. He added that without meaningful deficit control, yields on 10-year bonds are likely to remain elevated, within a 4.5% to 5.5% range, unless a recession intervenes. Stocks ended modestly higher Monday despite the downgrade and mounting fiscal concerns. The dollar weakened while bond yields continued to rise. Strategists like Deutsche Bank's Jim Reed highlighted the lack of any, quote, serious deficit restraint, end quote, in the latest legislation, raising further red flags for investors. At the same time, trade tensions resurfaced. JP Morgan CEO Jamie Dimon warned on yesterday, that economic impact of tariffs has not yet been fully absorbed. He predicted potential market disruption as companies face higher input costs. President Trump, meanwhile, attacked Walmart for saying it would raise prices due to tariffs, insisting both the retailer and China should, quote, eat the tariffs, end quote. The uncertain macroeconomic outlook has led the Federal Reserve to hold interest rates steady this year, with New York Fed President John Williams saying policy direction may remain murky for months. And finally for today, we move to Asia. Nvidia CEO Jensen Huang reaffirmed the company's deep commitment to Taiwan on yesterday, unveiling a significant expansion in the capital, Taipei, that includes a new corporate base and a state-of-the-art AI supercomputer powered by thousands of Nvidia's latest chips. The announcement was made during a keynote speech at Taipei's Computex Tech Show, where Huang celebrated Taiwan as, quote, center of the computer ecosystem, end quote, and, quote, the largest electronics manufacturing region in the world, end quote. The new supercomputer will be built in collaboration with the Taiwanese government and Foxconn subsidiary Big Innovation Company, and will rely on 10,000 of Nvidia's powerful new Blackwell chips. The project is expected to cost hundreds of millions of dollars and serve Taiwan's broader technology sector, including key Nvidia manufacturing partner TSMC, which plans to use the system to develop next-generation chip fabrication techniques. Quote, we are growing beyond the limits of our current office in Taiwan, end quote, Huang said, presenting a futuristic video of Nvidia's planned Constellation headquarters in Taipei's Beitou district, designed to resemble a transforming spacecraft. The announcement comes at a politically sensitive time as President Donald Trump's administration pushes U.S. technology firms to ramp up domestic manufacturing. Trump's recent revocation of Biden-era restrictions has eased some concerns over Nvidia's global expansion, but export controls on AI chips to China, including Nvidia's H20 model, remain in place. Huang said no further modifications to the H20 are feasible and that Nvidia is still evaluating how best to serve the China market. Despite the pressure to shift manufacturing to the United States, Huang emphasized the enduring importance of Taiwan, noting that many of Nvidia's most advanced chips are still made on the island. The company also plans to spend up to $500 billion over the next 4 years on AI infrastructure, much of it in partnership with Taiwanese firms like TSMC, Foxconn, and Wistron. Huang also introduced NVLink Fusion, a new initiative to open Nvidia's GPU architecture to interoperability with custom chips from other companies, a strategic move aimed at solidifying Nvidia's dominance in the AI infrastructure space. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Tuesday, and I will see you for a new episode tomorrow.